Hey, Roseburg, good morning. Quite a bit going on this week. Let's take a look and see. This is a rate. It's about 5:30 p.m. Tuesday right now. Uh, Top one, two, three, four loan types here. No discount fee, and rates have continued to slowly decline. The 30-year fixed conforming conventional Fannie Freddie about 6.625. I'll shoot you a note Wednesday morning if we've seen more improvement. Uh, FHA, VA, USDA, pretty much in the upper fives right now with no discount. So you can buy those into the middle fives pretty cheaply right now. And this bottom one in red here, new loan program. It's a 5-year fixed arm, fixed for the first 5 years. Bottom right here, only 5% down, loan amounts up to 1.5 million. So this is basically what we call a jumbo product with just 5% down. They typically want 20% on those. And with one discount, 1% of the loan amount added to closing costs, we're in the upper fives, floating around 5.75 to 5.875, depending on the loan amount and how that affects the revenue. Now, this could be as low as a $100,000 loan. It's a really wide breadth loan product from 100,000 to 1.5 million loan amount. So I love this thing. It looks really good as far as arms go. And remember, the VA product, the VA loan goes down to a 550 credit score, all the way up to a $1.5 million loan amount. That's no mortgage insurance. It's great VA rates on that stuff with us. So I like that too. Uh, FHA update. This is huge. Point one, I'll go through this number by number here on the left hand column. Point one, non permanent resident aliens will no longer be eligible for FHA loans. When does that start? Point two, FHA case numbers assigned May 25th and beyond. You get your FHA case number when you go into contract. So you better have found a house and be in contract the first week of May or so, because not every lender gets that case number right away. They get it before they send the appraiser out. So we like to do it right away. If you've got people and one of the borrowers is a non-resident alien, even if they're DACA in the DACA program, get them into a house now if it's got to be FHA. Point three, it must be, as of May 25th, a permanent resident or a U.S. citizen. And as I said, DACA is a program for citizenship down the road, but they're not citizens. So they're likely not eligible. Point five, a non permanent resident can still go with a conventional Fannie Freddie loan, even at a 3% down payment for a first time home buyer. The question is for how long, right? If they are wanting to have only permanent citizens and U.S. citizens on these loans, they might wipe that away from Fannie and Freddie as well. Who knows? They're trying to push Fannie and Freddie out of conservatorship right now. I can't say for sure, but I kind of expect the worst, and you get people off the fence if they're on it and into an ownership position. Switch gears here real quick and talk about buying before you sell. Typically, that requires someone to have a whole lot of money to spend and a whole lot of income for the debt ratio, right? But this is a no bridge loan option. Point two here, we use a conventional recastable loan on the new home purchase. So, point three, initially, when you buy the house, you want to put down that $300,000 you're going to make from the sale of your house, but you haven't sold it yet, right? And so, how do you access that? Well, typically you access it with a bridge loan or something like that. But bridge loans can cost $4,000 or $5,000. So, what we do is on the purchase loan, we move in with a small down payment, like a 5% down payment. You still have all that equity in your home you haven't sold yet. So you purchase while you're still living in the home you're going to sell with a small down payment, 5%. You move, you stage the house, you sell this house a couple of months later. The home that you sell, you get your $300,000 in proceeds. Instead of having to refinance and pay $5,000 or $6,000, you wire that money to your loan servicer, and they not only reduce the balance, but they recalculate the monthly payment as if you put that 300,000 down when you closed. It's a way to apply the proceeds from sale after making the purchase. And the cool thing is, bridge loan costs 5 or 6 thousand, refinance costs 5 or 6 thousand, a recast with a servicer, it's a few $100. What they want you to do mainly is make 5 to 6 payments at that initial larger loan amount, so they make something for their trouble. But you can just contact them. The trick is that I need to know that this is going to be the case. Not every servicer does this. Not every loan type does this. Just conventional loans do this. And so when I'm talking with someone about this lower cost option, I make sure and earmark the lock when we lock in the rate to tell my secondary market guys this needs to go to a loan servicer that will allow for a recast. And they don't all have the exact same rules about it. It tends to be less than $500. They tend to want you to make a handful of payments before you do the recast. And ask me about that. I've got like 3 of those going right now. It's pretty good. People like it because they can get out of the house, so you can clean the house up and stage it and sell it for an optimal price. They're already living in the new place, and they're not getting tagged 5 or 6 grand because they have to refi instead of do a recast. It's a great thing to make you look good. Uh, I have an example here to go on the slides. That was what I just talked about. You're expecting 300,000, buying for 750. Initially, you're putting 5% down, so your payment at a 712 loan amount is about $5,200. 6 months down the road, you close on your purchase, prior home sells, you wire the 300,000 to the servicer. The new payment now is 3,300. So it's recalculated as if it was a $300,000 lower payment. We went from 5,200 to about 3,300 in this example without having to spend 5 or 6 thousand on a refinance. So I just love these. It does not restart the loan. You keep the same rate. It costs a few $100. Sellers move out without moving twice, and it's conventional loans only. So take a look at the slides and send me questions about that if you could. Finally, last thing, Rocket purchased Mr. Cooper. Mr. Cooper is the largest mortgage loan servicer in the country. About 2.1 trillion in loan volume, 10 million clients. And they're also going to probably purchase Redfin. So what does Rocket want to do? Rocket is a data company. Now they have all these people they're servicing. Now they have all these real estate agents. So point 3 right here, your new buyer has a pre-approval from Rocket. What do you think that means? That means that when you get into contract, what's Rocket going to try to do? They're going to try to direct your buyer to a Redfin agent because they have a lower BAC they're going to tease them with. They're going to try to take from your sphere and make it their sphere. And this is definitely going to happen. These moves are designed to attack your sphere. So if you see a Rocket pre-approval, get my card in their hand because we will go as deep as we need to go to protect your sphere and beat that Rocket pitch. And that goes for, a lot of companies that are Compass, by the way. They're in bed with Rate, used to be guaranteedrate.com. So when you see a lot of these pre-approvals, let me meet or beat them so I can keep them in your sphere and send 5 years of marketing with your branding on it after we close. That's my big sales pitch for the week. I'll see y'all soon. Thank you so much.